you've got to be prepared to, when you buy a stock, to have it go down 50% or more and be comfortable with it as long as you're comfortable with the holding.
Hi, JJ here with the Art of Value. That, of course, was Warren Buffett with one of his quotes. I've been doing a few quote videos lately, just short form videos, that have been popular, so I thought I'd make it into a longer, like 3 of them into a longer video. Buffett there was talking about you have to be comfortable with the stock going down 50%, which is, of course, is relevant lately. There are a lot of stocks, especially tech stocks, that have gone down 50% or more, up to 90%. So what he says elsewhere is that you need to have conviction in it to be able to hold it when something like that goes down. And the way that you have conviction is to understand the company. Podcast I did about Monash Pabrai last time, he was talking about that too. And that's what he said. In order to develop conviction, you have to understand the company. All right, so next up, I've got three quotes. Next one's from Charlie Munger, of course, Warren Buffett's partner, who tends to be a lot more direct, blunt in what he says. And so this is what Charlie Munger says about a similar thing.
In fact, you can argue that if you're not willing to react with equanimity to a market price decline of 50%, 2 or 3 times a century, you're not fit to be a common shareholder, and you deserve the mediocre result you're going to get.
So he says if you're not willing to stomach a 50% decline in a stock, you're not fit to be a shareholder. But 2 or 3 times a century, I mean, that's happened. It happens kind of more than that, really. Maybe he's talking about the whole portfolio, but he goes on to say, or it's said elsewhere, that even Berkshire Hathaway, their own company's gone down more than 50% 3 times since they've had it. And so again, you've got to have a lot of conviction in the stock or the company. So the last one is Peter Lynch. Peter Lynch also said a similar thing. Isn't it interesting that all these investors are saying the similar thing, which is why I pulled these quotes together.
That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens.
So again, he says you shouldn't be a shareholder if you're not willing for a stock to go down. In fact, you should, it's said elsewhere, you should expect it to go down after you buy it, because you can't. It's unlikely you're going to bottom tick, even if you're trying to buy it after it goes down. It's unlikely you're going to hit the bottom of the market or the bottom of a stock. So, Peter Lynch in that speech, I think it was 94, he talked about the same thing. The stocks can go down 50%, and that's a good time to buy it. So that's why he said it's good when that happens, because if you have an understanding of the company and stocks go down, you should like it. It's only when you don't understand it that fear creeps in and you're likely to sell. All right, that's it. 3 really good quotes, I think, from 3 different investors about a similar thing and relevant to what's happening in the market today. So if you found value in this, like and subscribe, and follow me on Twitter at The Art of Value. And I will see you next time.